budget really looked at what it can control, and what it can control is on the expenditure side. And I think the focus correctly remained on expenditure restraints. So we're actually seeing a reduction in nominal spending cuts, a reduction in non-interest expenditure cuts, both in 2021, but also in 2022. And that is something that's quite unprecedented in South Africa. We have not seen that before. We're not even talking about real decreases in non-interest expenditure. We're talking about nominal decreases. So, not adjusting for inflation. In real terms, it's even more substantial. And so I think in particular here, the focus is on things like the public sector wage bill. The public sector wage bill right now is eating up nearly 45% of non-interest government expenditure. It's eating up more than 50% right now of government revenues. So it's clearly something that's bloated. It's clearly something that the Treasury want to try and ensure that they can keep a lid on that, because quite frankly, it's gotten out of control over the last 10 years, where most public servants have enjoyed CPI plus 2 to 3%. And that's created a largely unsustainable wage bill. So, but there have been other cuts. But in general, I think this is a government that is moving away from, let's say, consumption expenditure towards investment expenditure. And while on paper that is good news, it's a risky political gamble. If you look at the breakdown of where expenditures are going to be cut and where expenditures are going to be ramped up, you still see, so you do see a ramp up in infrastructure expenditure of the state. That's going to be growing in nominal terms of about 12.5% per annum over the next 3 years. That's good news. However, if you look at where the cuts are coming, compensation is the one that I mentioned earlier, which we would argue needs to happen. But the other one that perhaps is a little bit more unsettling in terms of the budget is households, and that is in particular social grant expenditure, where in inflation adjusted terms, we're actually talking about decreases or cuts in real terms to household grant expenditure over the next 3 years. And so we're in a local government election year, as we know. We know that there's a lot of political pushback that Tito Mboweni is likely to get on the back of this budget. And already we're starting to see that play itself out in the media. So this is something that I think we are quite concerned about, because it does lend a degree of credibility issue to whether or not the Treasury is actually going to get the political backing to be able to cut expenditures in the way that it hopes to. The Financial and Fiscal Commission, which is the advisory body that advises government and the Treasury on what it should be doing in terms of the fiscal framework, have even sort of questioned the constitutionality of cutting things like welfare expenditure in such an economic climate. So I think we are a little bit more skeptical on the ability of the Treasury to be able to cut as aggressively. But I think importantly, what we're watching for over the next couple of months is holding the line on real compensation cuts to the public service. This is fundamental to any form of debt stabilization that the Treasury is hoping to get. Right now, negotiations have just kicked off for the next 3-year wage round. And just to put into perspective how far away the unions are from that of government, unions' initial demands are CPI plus 4%, versus the government's proposal, which is a freeze on wages in nominal terms. So there's a long way to go before we get any form of clarity going forward on things like the public sector wage bill. We're also worried about the long-term debt sustainability problems in South Africa. And, this comes down to really growth, which we think that there are big structural impediments to growth: electricity supply, a delayed vaccine rollout with regards to COVID, a very weak fixed investment climate where confidence is at super low levels, in fact, multi-decade level lows. And so, for us, the Treasury sees debt stabilizing below 90% of GDP over the next 4 or 5 years. We don't see that. We think that real financing costs are going to continue to outstrip that of real GDP growth. And as a result, it's going to be very difficult outside of a big boon to revenues or a big boon to growth potential that's going to be able to stop debt from surpassing 90% of GDP over the next 3 years. We think debt in 3 years' time will hit about 93% of GDP, and probably head towards that 100% of GDP mark if we don't get the right policy frameworks in place to get growth. So we are still worried about that. And already South Africa has seen one of the fastest jumps in debt in emerging markets. We've had a 40 percentage point jump in our debt to GDP ratio over the last 10 years. We are the standout EM in that respect. Our projected 5-year change in gross debt is also one of the highest over the next 5 years, according to the IMF, something that we'd agree with as well. So, but, the investors that we speak to as well are also cognizant of the fact that South Africa is not an Argentina. We don't have high degrees of hard currency or foreign currency denominated debt. It's around 10% of our overall debt stock. Argentina's is 90% of their debt stock. So when you get a blowout in the Argentine peso, you get a blowout in debt metrics. We don't have that in South Africa. We have a long average term to maturity of our debt. It's on average 12 and a half years. But unfortunately, it's coming at a very high premium to growth. And, while currency depreciation doesn't massively impact on the ability of us to service that debt, it is, I think the sort of long-term debt sustainability problem of weak growth and interest costs of the government surpassing that are a big problem for long-term debt sustainability. So this is front of mind for investors, but we're not facing an outright debt crisis in South Africa. The Treasury, I think, is still seeing in its weekly bond auctions, demand at auctions 2 to 3 times oversubscribed. So this is not something that we are particularly worried about. We're not about to knock on the IMF's door for a conditional IMF facility. But if we don't get our house in order in the next 5 years and debt sustainability starts to unravel, you don't have a debt problem until you have a debt problem, until you're not able to actually fund yourself anymore. And right now, we don't face that because of a very ample global liquidity environment, lots of cash in the system looking for yield. But that's not going to remain forever. So we need to make hay while the sun shines. So that's how we would contextualize Budget 2021. I think there's a bunch of issues with regards to, that we can go into maybe in the Q&A with regards to the COVID situation. Yes, we flattened the curve, but we are way behind in terms of our vaccine rollout plans, which means that there are big constraints to growth this year. And, I think the risk of a stop-start economy and a third wave of infections in our winter months is very, very real. Alternative data tells us that, if you look at mobility statistics, the economy is still only operating at 25% below levels where we were pre-COVID. We are seeing some parts of the economy, like mining, for instance, that is recovering very strongly, but other parts of the economy, like new vehicle sales or construction sector, which remains well below levels pre-pandemic. We've got energy supply gaps in South Africa that are widening, by about 60%. We think our energy supply gap this year is going to be 60% larger than last year, for instance, which means that load shedding is a reality over the next 12 to 18 months. So there are huge, huge problems that we need to be addressing from a policy standpoint, and we need to be able to crowd in that private sector investment. But in order to do that, we need the right policy frameworks in place. We're riding on the coattails of a global recovery right now. We're seeing equity markets at all-time highs, including our own. We're seeing very strong terms of trade in South Africa, where commodity prices are helping boost our exports, which right now are actually at record levels to the likes of Germany and China and the US. But we need to be taking advantage of that. We've got a central bank that is extremely well regarded in global terms as one of the most credible central banks in the world. We've got a low inflation environment relative to a lot of our emerging market peers, and that's expected to continue. And that's going to help boost our real yields. So we've got a lot of good things going, but at the same time, we've also got a lot of messy politics. We've got angry unions in a local government election year, and we've got a lot of lack of state capacity and corruption, which remain core challenges of the ability of us to get our fiscal house in order, but also to get our growth house in order. So let me leave it there, and I'll rely on all of you to come up with some of the questions for fear of talking too long. So on that front, let me hand over to Diane.
Jeff, just one point. Yeah. I think definitely the CFOs around the table want to know what's happening to the exchange rate, or what will happen to the exchange rate because of the budget. We can cover very quickly.
Yeah, so the exchange rate, look, I don't think the budget directly would impact on the exchange rate. Right now, the exchange rate is being driven predominantly through what what we see in global markets. So right now, the sell-off that we've seen in most emerging market currencies has been driven through an expectation that inflation is going to pick up globally, and it's going to force the US Federal Reserve to start hiking interest rates earlier, to start tapering its bond purchases, and that's causing a little bit of a headache, or wobbly, let's call it, for emerging market currencies. Now, the rand has actually held up remarkably well relative to some of our peers, for instance, in the likes of Brazil, the Brazilian real, for instance, or the Mexican peso. And why is that? So the reason being is that, yes, our macro fundamentals look very weak, but there is a very important structural underpin to that's helping the currency right now, we believe, and that is in a very positive external account balance that we have right now. So I mentioned terms of trade earlier and boosting export receipts when imports are super low because we have a relatively weak domestic demand environment, or a very weak domestic demand environment. That means we're running trade surpluses right now of 9% of GDP. It's record highs. We haven't seen higher trade surpluses in this economy. And as a result, our current account is running a surplus right now, and it's one level of a very ample global liquidity environment, which is where there's the search for real yield, and South Africa offers that very nice, healthy real yield, coupled with a current account in surplus and record high terms of trade, is supporting the currency. And so from a currency standpoint, we still think in the short term, currency can probably trade in a range of between 14 to 15 to the dollar. But longer term, medium to longer term, we still think that the weak economic fundamentals of the country, the fiscal sustainability concerns that we have, means that we probably are looking at a currency that settles around the 16 to the dollar mark over the weak currency view. We also don't have a significantly stronger currency view. We think that the currency actually starts to settle in this sort of range bound that we have right now. So, the difference between 15 and 16 to the dollar in as far as the currency, in as far as the rand is concerned, which is the most volatile, high beta EM currency and proxy for risk that we see anywhere else in emerging markets, a range of between 15 and 16 to the dollar is actually a pretty well-behaved currency, we would argue.
Hi, so good afternoon. So it's Taki from Liquide. I just have a few questions, and I don't know if maybe Diane was going to also touch on that, but I'll just put it up for now. So if we look at where we are in terms of the sovereign debt, we are sitting at 81% of debt to the GDP, and we are seeing, there's quite a few reports or some comments in the market that suggest that considering that we're already on a negative watch with Fitch and the other organizations, we are most likely going to be downgraded because of our sovereign debt, and we're most likely going to see the sovereign debt crisis, where we would probably go into over 100% of debt to GDP. So I would just like to know from your point of view, do you think that really now this crisis is on our doorstep sooner rather than later? The second part as well is that if we look at the COVID crisis, it's becoming a lot more of whoever manages the COVID crisis well will see their economy recover and grow a little bit more faster than anyone else. So it's sort of like how do I put it? It's sort of like if you do it well, you're going to be, top of the list. If you don't do it well, you're not going to recover anytime soon, and therefore your competitiveness in a group, in the global scale, lessens if you're not managing it well. in South Africa, I mean, we were hoping that by the winter, at least the majority of the people in the frontline industries would have been vaccinated. It doesn't look like it's going to be that way. And therefore, we sort of like really, putting ourselves back in terms of, reintegrating into the global space. How do you see us recovering well if we're not managing the COVID crisis well?
Okay, great. So thank you for the question. So, I mean, in terms of the debt dynamics, I think both Moody's and Fitch and S&P have all come out saying that, much what I've said is that it's going to be very difficult for South Africa to stabilize its debt below 90% of GDP right now, over the next couple of years. So that remains a base case of the rating agencies. Now, as we know, Fitch have us on the lowest bound of BB- with a negative outlook. So they are the rating agency to watch, because they are the biggest. We run the biggest chance of them being the first rating agency to move South Africa to a single B credit status. Moody's have us one notch above that of Fitch, also with a negative outlook though. But I think they could well move lower in the next couple of months. But I think fundamental to what they want to see over the next couple of months is implementation. So if we see any slippage in the non-interest government expenditure cuts that we've promised, if we see slippage in the public sector wage bill, if we see further deterioration in GDP growth, that could be the trigger for any one of these rating agencies to downgrade us. Now, does that necessarily mean that South Africa faces a sovereign debt crisis as a result of an additional downgrade out of Fitch or Moody's? I would say no, because we've already moved out of key investment grade global bond indices. An additional downgrade, I'm not downplaying it. It would certainly be negative for sentiment, and it's a slippery slope into single B territory. But it also is not going to prompt a massive amount of outflows out of this economy. That's already taken place in anticipation of Moody's, which was the last rating agency to move us to sub-investment grade. So where do we face an imminent debt crisis? Not in the next 3 years. But if we don't get our house in order with regards to better growth, with regards to some form of fiscal credibility, bringing in our primary budget back into balance over the next 3 or 4 years, then we are going to face an inevitable debt crisis. So right now, we're riding on the coattails of a global economy which is in recovery, where there's super low interest rates globally. There's huge amounts of US dollar liquidity searching for a home. And so we're able to fund ourselves quite easily. But that picture can change when the Fed starts tapering its QE purchases, when we start talking about interest rate hikes out of the US and the Eurozone. So, I think we do face that inevitability if we don't start to get our house in order. But I'll put my neck on a block and say, do we face a sovereign debt crisis in South Africa in the next 3 years? My answer would be no. And then on the COVID crisis, I mentioned it, I think, early in the presentation. South Africa's fallen way behind in terms of its vaccination program. Part of it is poor planning, I would argue, on behalf of government, where we were very late to the party in securing and preemptively securing a significant amount of vaccines. We've also had a little bit of bad luck, I think, in our defense as well, in the sense that there have been the South African specific variant where the efficacy of the AstraZeneca vaccine, for instance, has been questioned. And so we've had to pivot to Johnson & Johnson now. There's a global shortage of vaccines right now. That global shortage is going to work its way out as most global manufacturers are working very hard where I think in the second half of the year, we're going to have a surplus of vaccines rather than a shortage. But bottom line is that, yes, we've fallen 6 months behind, I would argue, in terms of our emerging market peers and our developed market peers in getting a vaccination program rolled out quickly. So that does mean that the economic recovery this year is going to take that much longer, and we're going to fall that much further behind than our peers. Our forecast is for growth of 3% this year, where you're looking at other parts of the economy in the rest of the Central Eastern Europe, Middle East and Africa, where you're talking about growth, in excess of 5%. even parts of Latin America, growth in excess of 5%. We are only talking 3%. So yes, I think it does. If we don't get a meaningful vaccine program rolled out, of course, it's going to negatively impact on activity, mobility. It's going to impact on confidence. So this has to be front of mind for the state. And I think it is. It's, 20 billion rand or so has been set aside in the budget, which should be more than enough, along with private medical aid companies, to be able to roll this out. But yeah, it's got to be front of mind, and I think it was highlighted in the SONA by the president as priority number one, maybe second to the energy crisis that we face.
Thank you very much, Jeff. I suggest that we keep additional questions for the end of Diane's presentation. So Diane, please, the floor is yours for the tax side of the budget event. And after your presentation, it will be open to any question, including for you, Jeff, of course. Thanks.
Right. Good afternoon, everybody. And also just to reiterate from my side, it's really great to be joining you all. Firstly, some good news. And how often do we hear that and tax in the same sentence? As most of you know, because I know you either had to do it or you had to sign it off, our taxpayers paid their second provisional tax payments for 2021 at the end of February. And what they realized was that in the budget speech, our minister said to us that we were going to have a 213 billion rand tax revenue shortfall. But the good news is the actual figures are in, and they actually collected 30 billion more than they thought. So our shortfall is actually now sitting at 183 billion. Now, I don't want anyone to get lax about that. Let's not worry about what the predictions were. 183 billion as a shortfall is a massive tax shortfall. So what I want to do is also just remind you what Jeff said, and that was that we really, really were encouraged by the stance the minister took by identifying that tax increases, especially when we're in an economic downturn, will harm an economy much more than a cut in government spending. And that's where we didn't see any, as Jeff said, of the big taxes materialize. But what our minister did do is he's put his tax collections in he's hung his hat, should I say, on two pegs. Number one, they are fundamentally relying on economic growth, the economic reforms being implemented that we need to ensure that growth happens, and increases in employment so we can increase our personal tax collections, we can increase our consumer spending and thereby increase our VAT, and of course increase our corporate tax collections. So all the government planning that we saw coming out of the State of the Nation address has been completely relied upon by Treasury to collect some of the extra taxes that we're going to need. The second thing the minister's done is he has also, and very, very thoughtfully so, relied on an increased administrative capacity within SARS to collect the taxes that we need. And I want to chat about this because our minister must please stop shouting at the Zondo Commission and telling them he's not going to give them any more money to finish their work, because we're going to see one very interesting area where a lot of extra taxes are going to be collected. But ladies and gents, what I do want to do, though, is just introduce a thinking process that came out of the budget speech that we haven't seen before. And it's one which is understandable, but it's also one of great concern. And for the first time, the minister said to us they wanted to relook at some parts of the Income Tax Act to make sure that our Income Tax Act was being more progressively applied. And what he said directly to us in his speech was they wanted to go and make sure that in terms of the Income Tax Act, specific groups or specific sectors of taxpayers were not benefiting by tax deductions because, for example, they had a certain amount of wealth, or because, for example, they were in a particular industry. Now, the reason why this type of thinking is understandable, we do see this inequality gap opening up, particularly after the effects of COVID and our pandemic. We were a very unequal society before, and that's now simply become more so since our pandemic. But ladies and gents, it's a tough one, because when we speak about making sure that tax breaks aren't taken advantage of by specific taxpayers. And as I said, the minister indicated the wealthier taxpayer or specific sectors of industry. What that does concern me is that we do need the wealthier taxpayer and efficient sectors within our industry to really be encouraged at the moment by those tax breaks and those tax incentives. So when we start taking this view that we're going to have a more progressive application of our Income Tax Act, we are really having to ask clearly that Treasury balance that up against the incentives that are needed to get taxpayers to invest in that private-public partnership that the president spoke about in his State of the Nation address. Because if we want that private sector involved, we're going to have to incentivize it and not take the incentives away. And of course, one big one, for example, and this of course sent major unhappiness across the industry, was this sudden taking away from the end of June, the proposal to take away the tax incentives around venture capital companies. Now, ladies and gents, as we know in South Africa, raising venture capital is an extremely, extremely difficult endeavor. But if we want to start up new business and we want to get capital and venture capital into that new business, we have to have the incentives to do it. So as of the end of June this year, that whole incentive that surrounded taxpayers who put money into venture capital companies who then on invested in startups, the big tax breaks those taxpayers got investing in and buying equity into the venture capital company are now simply falling away. Now, this leads me to another issue that I want to talk about, because part of the reason, and let me use that venture capital company incentive as an example, part of the reason why Treasury is fundamentally against tax incentives in a large degree is, number one, down to the abuse of those incentives by taxpayers. So, ladies and gents, when Treasury had a very good look at the whole 12J venture capital company that allowed a taxpayer individual buying shares in a venture capital company a deduction of up to 2.5 million rand a year, they looked at the type of entities that were being squeezed into that incentive, and it was not the business development entities that the incentive was designed for. So this was a perfect example of Treasury finding that they put forward this incentive, huge advantage was taken by taxpayers, it was not used for the very purpose the incentive was created. So what we do see is this fundamental lack of trust. And Jeff referred to this a bit earlier when he spoke about tax morality. So we've almost had this idea by taxpayers that they're going to find any gap that they can to pay the least tax possible, to make the use of any tax incentives they can, to squeeze themselves into definitions in those sections that were never meant for them. And it's almost this combative approach to Treasury and SARS that I will not pay my dues because if I do, there's no guarantee that the money will be spent efficiently, accountability, and I'm going to get bang for my tax buck. Now, what I want to speak to is, if the economic reforms take place, and that means that the public part of the spend that has to happen happens efficiently, and it happens effectively, and people start seeing their taxes actually creating the infrastructure spend and the infrastructure output that we need to grow the economy. If people start seeing that, then a tax morality stands a chance of changing, because people start thinking, hang on, then is it maybe possible that maybe in a year or two's time, our minister re-looks at some of the incentives and says, do you know what? Let's keep some of these in place. And I'm not talking about the venture capital one here. I think that is going to go at the end of June. But other tax incentives that they are threatening to look at, for example, employee incentives where an employer pays to upskill employees and get certain tax deductions, certain construction incentives around urban development zone when construction companies go in and fix up dodgy parts of towns. So these are the incentives that Treasury says they want to look at. And maybe if there's a bigger trust between the taxpayer and SARS and Treasury, we will see this focus on the incentives rather being left alone, letting taxpayers enjoy the incentives they're entitled to. And this rather alarming idea that the progressive application of the Tax Act means that there's no reward for anyone and thereby no incentive to do the economic development that we need, maybe we can see a backing away from that. Now, the second thing I just want to address here, well, there's two things really that I still want to get to. And number one is, please, ladies and gents, that decrease in the corporate tax rate from 28 to 27%. A lot of commentators have said, it's very nice to come down 1%, but in fact, in order for us to be competitive and to get the investment into new companies and companies in general in South Africa, we need to go down to a corporate tax rate around about 25%. So we don't know if that's going to happen. But can I just remind you, please, that when we look at a corporate tax rate of 27% even, please don't forget that once an amount has been taxed in the company at 27%, our new rate coming in, to get the after-tax profit out to a shareholder is going to incur a 20% ultimate dividend tax. Now, ladies and gents, if you look at the company tax rate of 27 and getting that after-tax income out to a shareholder ultimately and paying the dividend tax, it means even at the new corporate rate of 27%, to pull finally a dividend out of a South African company, the overall tax cost of that is still 41.6%. And that's a big ask for a shareholder to invest into and put capital into SA companies when that's the actual cost, 41.6%, even at the new 27% rate of getting that ultimate after-tax profit out of a company. So we've got to think about that. And then also, of course, the fact that the minister was extremely clear that the decrease in the corporate tax rate is going to be tax neutral for SARS. And what that means is, despite the company rate coming down, they are going to ensure SARS doesn't collect less tax. And unfortunately, the one way that they're thinking of doing that is by, when a company has a tax loss, restricting the amount of that loss that can be used when it's carried forward each year. Now, I need you to think about that. If a company is in a tax loss situation, it means it is facing difficulties. A tax loss may be great for tax purposes, but it's not good in reality. So if you take a company in a loss situation, they start making taxable income finally, but you restrict the amount of the assessed loss they can carry forward, you're going to force that company potentially into a tax-paying situation, which it might not have been in had its use of its assessed loss not been restricted. So we've got to really think about that. And ladies and gents, of course, the other big one is the interest deduction that they want to now limit a company from being able to claim. So let's think about it. We saw the speech coming, or the one sentence coming out in the minister's speech saying South Africa owes a lot of money to a lot of people. Well, the situation's no different for SA companies. And because it became increasingly difficult to access credit from financial institutions in some instances, many South African companies have had to borrow either from their holding companies, local or foreign. They've had to borrow from other shareholders, their trust shareholders, their natural person shareholders. And what this did was it meant that that funding into the company was being extended by what tax calls as a connected person. As I say, an example is your holding company, a trust that owns shares in your company. If it's a simple structure, a natural person shareholder. So now the companies are borrowing from these types of connected parties, local or foreign, and they're incurring an interest expense servicing that debt. But they're deducting the interest expense, so it's decreasing taxable income, decreasing tax payable, and freeing up more money to service the debt. But now one of the things that we're seeing being proposed is that interest deduction be limited. And when a company looks at 30% of its earnings, the interest deduction being limited to what 30% of its earnings would be. And ladies and gents, for some companies just finding their feet 30% of their earnings, when the earnings are still low, could be a very small amount. So therefore, the deduction will be limited. And companies might end up looking at this and going, geez, we actually wish for the days of the 28% when we could utilize our assessed losses and get an interest deduction that was fair and reasonable. So just be careful also of some of these things that are lauded as the big saving in the corporate sector. But the last thing I want to touch on, and I really, really want you to understand the implication of this, is that, like I said to you, the minister has agreed 100% that all the economic reforms and the GDP growth and everything is going to happen in the next few years, as we're hoping it will. That's where he believes some extra revenue will come from. But, ladies and gents, what we did see, as many commentators said was a silver lining to the budget speech, was an extra 3 billion in spending that's been allocated to SARS, and rightly so. I am a major fan, funny enough, as a tax advisor of our current commissioner, Mr. Kisvetter. I truly believe he has done outstanding work at SARS. But we've got a brand new bromance that's developed, and that is between our existing commissioner, Mr. Kisvetter, and our old friend, Judge Dennis Davis. Now, remember Judge Dennis Davis? He headed up our tax committee, and what he's helping Mr. Kisvetter do is to decrease the tax gap. And ladies and gents, the tax gap is the difference between taxes that should be paid and taxes that are paid. So what's the deal here? The whole focus and what this 3 billion is going to do is to increase the capacity at SARS to go after the non-compliant taxpayer. Now, because they've got all the recommendations coming from the Davis Tax Committee as to how to reduce that tax gap, to make everybody pay the taxes that are due, what we will see is a fundamental focus at SARS, because of the information and the advice they're getting from the Davis Tax Committee. Two big areas of focus are going to be your high net worth individuals and, ladies and gents, cross-border transactions. Now, what's the deal? Well, a lot of that 3 billion that SARS is going to get is going to go to two places. Number one is to get back and restaff SARS with technically skilled staff. Now, I need you to be very careful about this, because when we talk about cross-border transactions, a number of you attending today will be very aware of these, because you are involved in these international group structures with holding companies offshore, subsidiaries in South Africa, or holding companies in South Africa and subsidiaries outside of South Africa. So there's a lot of transactions going between these multinational group structures, and there's services being delivered, there's service fees being charged, there's product being sold, goods being delivered. And the demand is that all of this happens at an independent market-related price. So if I'm going to charge someone for a service, it's a market-related arm's length price. If I'm going to sell you goods, it's a market-related arm's length price, despite the fact that you and I are a resident in South Africa and outside South Africa, non-resident connected party. Now, this falls under the guise of transfer pricing. And one of the things that SARS is doing is, as they spend their 3 billion they're going to get, is they are fundamentally upskilling their transfer pricing team within SARS. Now, remember, ladies and gents, in the corporate return and outside of the corporate return, a lot of information has to be sent to SARS by our big multinationals, proving to SARS that you are doing everything at arm's length prices. Your services are being correctly charged. The amount of interest you're paying is correct. You're selling goods for a market-related charge. Now, what's going to happen is when SARS upskills itself from a personnel and a technology point of view, you're going to see a lot more focus on this information and being able to digest it and ensure that the transfer pricing provisions are being correctly implemented. So please, if you are involved in these international transactions, your transfer pricing documentation is going to be unbelievably carefully looked at by SARS. And the last bit of good news is, when we talk about high net worth individuals and SARS going after them, you are going to have to make sure your trusts are in order, You're going to have to make sure offshore investments are correctly accounted for and disclosed in local returns. Why? Because remember, South Africa is part of over 90 countries now, including Mauritius, Cyprus, Guernsey, including Dubai, because United Arab Emirates is in. We've joined up with over 90 countries now to automatically share financial information between us. And what that means is, if I as an individual, South African resident, have a bank account in Dubai or Mauritius, that bank is sending SARS information directly now about what is sitting in that foreign bank account, interest earned, and all sorts of things. And to prove to you that SARS is now using this information, they've got the technical skills and they've got the technology to access this information, digest it, and link it to tax numbers. Ladies and gents, for the first time in December last year, we got letters directed to certain of our clients where SARS had identified foreign bank accounts and they wanted a whole lot of information from the client about those bank accounts going back from 2015 all the way to 2019. And then, if you feel sorry for this lot, the last little thought that I want you to leave you with today is the following. Ladies and gents, please don't forget, tax doesn't mind whether what you're doing is legal or illegal. And please do not underestimate the fact that stolen monies and monies received in respect of a bribe are fully taxable in South Africa. And if you want proof of that, just go and have a look in the newspapers and we'll see some big political names too at the moment that are actually facing criminal charges for tax evasion. And this is stemming from amounts received in respect of assisting tenders being awarded and things like that. So while you're feeling hard done by, if you're having a small audit from SARS, please just remember that when we go after non-compliant taxpayers, we are also focusing on any earnings from illicit activities, bribes, cigarette sales, illicit cigarette sales, and things like that. And that is a fundamental focus of beefing up SARS. And they reckon that almost 100 billion in taxes is waiting to be collected from this beefing up of SARS. So I hope that cheers you up a little bit after some of the economic talk, which got me a bit down, but happy to ask or handle any questions you guys may have in respect of our budget speech and just thoughts in general.
Thank you, Diane, very much. Most of the companies around the table are in the case of being a subsidiary of a group in France, and your advice on the transfer pricing policy is, I'm sure, excellent, and I'm convinced you may have some questions today or at a later stage. I just want to come back on the 1% gift on this income tax. You said that SARS, in any case, was clear on the fact that they want to break even, so they will have to find the money somewhere. And you explain what is the plan today. If the plan doesn't go as expected, do you think there is a risk that this dividend tax increase next year in order to compensate for this 1%, which would be for the case of all the companies around the table, actually going back to 1% taxable on the total money they are trying to send back to the head office?
Sebastian, I think we were actually quite concerned this year about a potential increase in dividend tax because at a 20% tax rate, it is a fairly low tax if you look at our marginal rate being 45%. But I think what also the concern is with the dividend tax is it takes a while for SARS to be able to collect it. So the moment I'm declaring dividends from local company to local company to local company, none of the tax is triggered. It's only when it goes ultimately out to a non-resident holding company or a non-company shareholder local that we trigger the tax. So if they do increase that dividend tax by 1%, I think they're going to get a huge kickback from trying to lure investors into South African companies in general, because I think also then a lot of your foreign investors are still going to be protected by the decreased rates in terms of our double taxation agreements. So I don't know that it would again, I don't know that the balance of any extra tax finally collected, because it takes time, would outweigh the immediate effect of the 27%. So I think they are going to quite heavily enforce that limitation of the interest deduction, and I think a little bit unfairly, some of the usage of the assessed losses, because companies with assessed losses actually do need a bit of protection going forward. They need time to find their feet, and they don't need to be in a tax-paying situation immediately.
Thank you, Diane.